Joe, what did you make of the numbers? The headlines look pretty disappointing.
Yeah, the headline was definitely disappointing. We were surprised that profit was as bad as it was. I mean, the company worked really hard to clear through inventory. And on the surface, when you see the 36% increase in inventory year over year, it doesn't look like they made much headway. However, if you keep digging underneath, you will find that they cleared through a lot of discretionary items, and they're clamping down on orders of discretionary items for this back half of the year. So they're really focused on getting better in stocks in essential goods. And they're seeing traffic into the stores to buy those essential goods. So, we're hopeful that things will look a lot better in the second half, but it was definitely a disappointing quarter. And actually, the third quarter is probably going to have to come down a little bit relative to current expectations.
Current expectations. I love this Bloomberg terminal headline. Target is betting its reputation on the second half. And so if you think about the second half of the year, how much downside risk is left?
Well, it definitely needs to see second half numbers come down a bit. Third quarter, I think, is going to be down. The street's currently forecasting around an operating profit of around 6% relative to sales. And they're saying it should be a bit lower than that. Fourth quarter, however, should rebound and be back to a more normalized level, closer to like 6.5%, 7%. So if that's the case, we may see a little bit of erosion, but things should start to get better. There's still a lot of inventory that has to move through. Consumer definitely seems to be a bit weaker based on what we've heard from Walmart and Target. We're going to see more promotions necessary to clear through goods. So you're going to see continued pressure on profits. But I think you're right. At this point, Target really does have to see some improving trends in their profit side of things, just operating better than they've currently forecast.
So execution needs to improve, but I imagine the
Yeah.
crystal ball is fairly difficult for these companies as well to be able to navigate, and it looks pretty opaque right now. Joe, how much of this is down to what happens with gas prices? How important is that in the second half of the year? They've come down 5.43. If they go back up to 5, what does the picture look like in the second half?
Yeah, I think that's a great point, Guy, because you really do have to see gas prices kind of stay down here. It really, as gas prices have come down through the quarter, we've actually seen most retailers talk about sales getting a little bit better as the quarter progressed, and then into July and now into August, sales have picked up a little bit. So there is definitely that correlation for the consumer. We'd like to see food prices come down as well. Food prices are currently trading at around 13% increases year over year. And that keeps accelerating. It was 11% in June, and 12, and then now 13. So if that can roll over and see peak, that could be a benefit as well. But listen, we heard from Walmart and Target that consumer has been trading down and focused on food and basic items, and really that they need to see a little bit of relief on other parts of their spending.
Yeah, relief. And, you look at all the companies in your universe here. We have a lot more information today than we had yesterday. Who is going to win out when you look at 2023, the new consumer in this new inflationary environment? What behaviors stick?
Yeah, well, we still think that the discounters and the grocers are very well positioned for the current environment. I think Costco is a big winner in all of this, because if you think about Costco, cater to a more affluent consumer, the affluent consumer is looking to save money as well. And so, they do a really good job, especially on basics, food, and things like that. We like Walmart. We like the dollar stores. I think that they're set up pretty well. Actually, Target, the stock price is pretty inexpensive relative to where it's traded historically. And if we can now come up with a new baseline here after today's earnings and look out to 2023 and hopefully see some improvement, that might look a lot better next year from a stock perspective. So I think that end of the market's pretty good. Home improvement's been holding better than people think as well.
That's exactly where I was going to go, Joe. What do you see housing holding up? What are you seeing in the housing trends? What do you see in home improvement?
So I think it's really important from a home improvement perspective to think about the drivers of that business, which are home price appreciation, aging housing stock, employment levels, people making money, disposable income. Those are different than the broader housing market. So housing turnover, that impacts the builders. So the drivers of home improvement are actually fairly solid for Home Depot and Lowe's to continue to perform fairly well in this environment. Pro customer backlogs are pretty high. We'd like to see the DIY customer, the do-it-yourselfer, get a little bit stronger. That was a pressure point at Lowe's this morning. But if that can come in a little bit better, we could see relatively decent trends for the home improvement space going forward.